to join us for our webinar. Today we'll be talking about investing in Latin American early-stage IT companies with your IRA or 401k. I'm Brian Davis with Accuplan, and I'm very happy to have guesting today Gustavo de la Fuente and Derek Footer of Origo Ventures. They'll be speaking in just a few minutes. A little bit of housekeeping. For those of you who have questions, there's a question icon in the toolbar, or you can write questions in the chat features. I know we got a lot of people on the call today, and some more people should be calling in, so feel free to ask any questions you have. A little disclaimer before I move forward. Accuplan, we're third-party administrators. We're not financial advisors, so please do your own due diligence before entering into any type of investment, as we're not advising into any specific investment as being a third-party administrator. I'll give a little background about myself and then about our company. Again, my name is Brian Davis with Accuplan, the Director of Business Development here in San Diego. I've been with Accuplan for just about 2 years. I was with another self-directed IRA custodian for almost 3 years before this. But my background's a little different. My parents were rice farmers up in Northern California in the Valley, Sacramento Valley. And I decided when I was 18 I wanted to move to Southern California. I got into college at UC Santa Barbara and graduated there in 2001. In 2002 I got into the mortgage business, which I did really well at until about 2007 when the market sharply dropped. So after getting into life insurance and annuities for a year or two, I found an opportunity with self-directed IRAs, and it was very interesting. I learned a lot. And for those of you that might not know much about it, hopefully I can introduce you to how it works. So right now I work for Accuplan. We're a third-party administrator for IRAs and 401ks. We have our own trust company called American Estate and Trust, which allows us to be an IRA custodian. So what we do is we allow people to invest their IRAs into everything allowable under IRS guidelines, and I'll get into that a little bit here as well. So for those of you that might not know much about a self-directed IRA, you're not alone. In 1974, the ERISA Act was passed by Congress, and it basically laid out the IRA structure that you have today. You have to be an IRA custodian, and you have to have an IRA custodian to direct your IRA investments. Most of the IRA custodians are the brokerage houses and insurance companies, which the products they offer are securities, stocks, bonds, mutual funds, ETFs, annuities, things that are publicly traded. However, that doesn't list everything that was allowable under those ERISA guidelines. So that's where companies like Accuplan can come into play and help people really self-direct their retirement into everything allowable under IRS guidelines. I know this is a little old, but at the end of 2010, there was just under $5 trillion in IRAs. That's not even counting another 10 or 11 trillion in qualified plans like 401ks and 403bs. The majority of that, as you might know, is in the traditional investment houses in the stock market. And at that time, there's about 2% of those assets were invested in the quote-unquote alternative asset marketplace, which we'll be talking a lot more today about with Gustavo and Derek. But that number of 2% is growing. It's about up to 4% now. And a lot of that is just the rise of the information age. People are being able to go online and learn about all the options with their retirement funds. It also helped a little bit a couple years back when Mitt Romney was running for president and his financials came out that he had a self-directed IRA worth somewhere around $100 million. Now, I don't see that ever, that size of one, but people could see the potential there and really started looking at the self-directed IRA market. This is what we're seeing at Accuplan that most people are investing in with us. They're investing in real estate. They're investing in notes. They're investing in private companies, similar to what Gustavo and Derek at Origo Ventures are going to talk about today, and precious metals. I don't typically see the precious metals investor. I mostly see those other three assets, but I do see those investors from time to time, and that's something we do allow. So the IRS never put out a list of acceptable investments. As you can see here, the list of what you can invest in goes on and on and on, whether it be LLCs, oil and gas, lease options. But the list, like I said, there was never an approved list. There was just a list of what you couldn't invest in. And they only listed two things: life insurance contracts and what the IRS deems as a collectible. These are prohibited investments in your IRA. So this is a list here you can see of the collectibles as the IRS describes it. So these are things your IRS can't invest in. Another one that you might hear about is S-Corps. IRAs aren't allowed to invest in S-Corps, and that's an S-Corp rule, as they don't allow IRAs to be members. Now, I have IRAs loaning money to S-Corps all the time and investing alongside, but not being members of S-Corps like they can of a other type of corporation. But it's not that simple. Besides those prohibited investments, there's something called prohibited transactions. A prohibited transaction, and I'll kind of try to cut through the jargon here a little bit, is when your IRA gets involved with what's called a disqualified person. And this is outlined in Internal Revenue Code 4975, if anybody wants to do some light reading. The essence of this code is saying there's no self-dealing in your IRA. So you can't have any personal benefit from your retirement account investment. And besides yourself, you want to think about this in a straight line up and down. Your parents, your grandparents, your kids and their spouses, grandkids and their spouses. They can't have any personal benefit to your IRA. So an example I like to give, you can't buy a piece of real estate, an investment piece of real estate in your IRA and rent it out to your college-age kids, because they would be getting a personal investment on it. And this also pushes out to companies in which you or those persons are an owner of. So you couldn't use your retirement dollars to invest in your own company. What are the penalties for that? Well, the IRS is pretty serious about these prohibited transaction rules, which is why I do highlight them. If you invest even $1 with a disqualified person, the IRS can go back and disqualify that retirement account from January 1st of the year that that disqualified transaction took place. As you can guess, that can have huge tax ramifications for folks and penalties, because if that transaction took place years in the past. So you really want to make sure you understand that before getting into any specific investment. I'll try to make this quick, play a little game here. Everybody remembers the NBC game Deal or No Deal from a few years back. We'll try to mix this in with these prohibited transaction rules. But could your IRA lend you $10,000? Deal or no deal? The answer to that, no deal. That's self-dealing. You can't lend yourself money out of your IRA. 401k plans, it's a little bit different, and I'll talk about that in a second. Now, what about your brother? Can your IRA lend your brother $10,000? Deal or no deal? That one on the face of it is a deal. It doesn't fall in that side-to-side category. Now, if the IRS were to say, oh, that would personally benefit you somehow, if there was some way you were trying to skirt around the rules by loaning money to your brother who is then just kind of giving it back to you, that could be considered prohibited under what they call the indirect rule. Now, what about your stepson? $10,000, deal or no deal? This one is deal. If it was your son, it would be no deal, but the IRS has said the stepson is a step away from that, so that can be okay. What about your daughter-in-law? $10,000, deal or no deal? That one's no deal. Your children and their spouses. So it gets a little tricky, and I just want to make sure everybody understands the highlights there. All right, so the next step here, all right, I think I get the rules here. How do I put money into a self-directed IRA? Well, self-directed is really just a marketing term, meaning we have IRAs that allow people to invest in all types of investments that are allowable under IRS guidelines, as we discussed. So if you have an IRA with another IRA custodian, we do what's called a trustee-to-trustee transfer and move the funds from your existing IRA over to an IRA with us, which allows for more control. If you're an employer plan like a 401k or 403b, you want to do what's called a direct rollover. And so you're direct the administrator of your old retirement plan to roll the funds over to your new IRA with us. Question I get here a lot is, what about my current retirement plan at work? Can I move those funds over? The answer to that is maybe. If you have certain types of those qualified plans, while you're in the plan, they allow what's called an in-service rollover. So you want to talk to your plan administrator if that's something you want to look into. And then last and not least, you can make an annual contribution. Now, it's April 9th today is the recording of this, and I still have the 2013 limits up because most of these plans allow you to contribute up through April 15th, like a traditional or Roth IRA, which you're allowed to contribute $5,500 a year. If you're over the age of 50, they let you do a catch-up contribution of an extra $1,000. Another plan that's very popular is a SEP IRA. It's a self-employed pension for a self-employed individual and maybe their employees. In this case, it works very similarly to a traditional IRA in that it's a pre-tax IRA. And the self-employed individual can contribute up to 25% of their adjusted gross income with a cap at $51,000. The thing about this plan is if you file your taxes and you push it out till October, you have until October to make that contribution. And the last one I do want to talk about here is a 401k plan, or you'll hear it called a solo K or solo 401k individual K. This is for the self-employed individual that has no W-2 employees. The IRS, when making up the 401k plans, allowed for the self-employed individual with no employees to have their own 401k plan where they can contribute as both employee and employer. And since they can do that, they can make that $51,000 contribution, just like a SEP IRA, but they can make it a lot easier because they're pulling from two different buckets of funds. There's also some other benefits with the Solo K, which I'll get into in just a second. So the Solo K, if you are fitting that role, you are the plan administrator, you are the plan trustee, and since you're the only participant, you don't have to have any third-party administrator involvement. You can control all of this. So if you have a plan like a solo 401k with us, which allows for these different types of investments, you can invest directly from your 401k plan into an investment like Origo Ventures. A lot of people still like to have a little space in between. We'll create a holding company like an LLC or trust, but most of my clients that are doing this are just directly holding it in their retirement plan. So it doesn't matter if you're a sole proprietor, if you create a corporation, you can have this 401k. You can roll over any other pre-tax retirement plans like other IRAs or 401ks, and then start making contributions as well and direct your investments. So again, you can purchase these alternative assets in there. Unlike an IRA, 401k plans allow the plan participants to take a loan out, and you can loan yourself up to $50,000 as a plan participant to the plan, and you pay back your own retirement plan. So there's some rules and regs there, but if anybody has questions on that, please let me know. Again, that plan comes with checkbook control, which a lot of people want to have in their IRA. So with an IRA, you can actually take full control of your IRA by creating a checkbook IRA. And this is a little tricky. This goes back to the court case from the 1990s called the Swanson case, if anybody wants to look it up, where this guy Swanson started an international business funded by his IRA in which he was the manager of. The IRS thought that that was a prohibited transaction, but the courts decided against it, saying no, he wasn't making any money as the manager of that international business, so his IRA could fund it. So that kind of created the checkbook IRA. A lot of places, they set these up via an LLC. In this case, the IRA becomes the member. The IRA owner becomes an unpaid manager. and they can invest directly from there. However, in California, that could get a little expensive to have an LLC, so the business trust has been something that's on the rise. So people can create a business trust that their IRA is the beneficiary owner of. If it's a single owner, just one IRA owns it, it's considered a disregarded entity, just like an LLC would, and so there's no federal tax. The difference being here is that it doesn't have to pay the California Franchise Tax Board like an LLC would, which for those in California is $800 a year plus something called a gross receipts tax. If anybody has any more questions on that, please check out my website, retirementcheckbook.com, on that. But we make it very easy to open up an IRA. You can open up your account online. Then we work on funding your investment via the transfer, rollover, or contribution method you discussed. And then you direct us to fund that investment. We generally take about 2 days to get that done. Again, that's my presentation showing everybody how they can invest in their retirement dollars in these alternative asset spaces. Here's my contact information here, AccuPlanSanDiego.com. And with that, I'm going to turn it over to Gustavo and Derek. Guys, are you guys there?
Yes. Can you hear me?
I can. And Gustavo, I'm going to put this over to your screen right now.
Give me just 1 second. Should be there. Are we there?
All right. It looks good.
Well, thank you very much. Thank you, Brian, and those listening to us today. We want to talk about Latin America early stage investment. Before we get started, give you a little bit of an idea as to my background. Derek, I'm sure, is going to speak to his, but I grew up in Mexico, between Mexico and the United States, and right on the border, actually, on the Arizona-Sonora border, and have been involved in a number of different companies over the years in banking, commercial banking in Mexico City and Monterrey, and then I've held positions in family-owned businesses in media, newspapers, regional newspapers, and cable television companies in northern Sonora for the last 10, 11 years. And moved to San Diego 4 years ago. I've actually spent over half my life in this country. I went to college at Stanford, graduate degree also there, and then got my MBA from the Harvard Business School in the mid-'90s. And really moved to San Diego 4 years ago. I've started a business center here in the La Jolla UTC area where we really work with a number of small companies, many of which are actual startups in the IT sector. And we have been working with them now for a couple of years, and so the business has been going on, doing well here. And I've gotten involved with angel investing over the last 3 years, and hatching this idea of the Latin America early investment stage with Derek Footer about 2 years ago when I met him, and he had had the idea. We got together and we started thinking about how it was that we were going to do this, along with another 2 managing partners for Origo Ventures. So I'll let Derek speak a couple of minutes about his background before we actually get started with the presentation.
Hi. So my background is more from the entrepreneurial side. I'm actually a lawyer, admitted in New York and California, but I got involved in the internet world in Chile about 18 years ago when I started a company that did basically a Yahoo for Latin America. And then I've been on that side ever since, working in technology companies both as startups and at companies like DirecTV and OpenTV who do technology behind television. And the idea to start the firm came a couple of years ago when I was researching different things in Latin America and found that the governments there were trying to transition their economies from resource-based economies to knowledge-based economies. And as a result, they were funding things like startup entrepreneurship and things like that through funds like ours. So one of the initial things that made it interesting was that the Chilean government is funding up to 3 times leverage. So for every dollar we put in, up to $3 we can get back from the government to invest, and they take it as a loan, so it's really inexpensive in the terms of venture capital. And also at the same time, there's a huge transition from in those countries from these resource-based type industries to knowledge-based industries. Startup Chile, similar programs in Colombia and Mexico enable entrepreneurs to get access to money and start companies as well. So that's why Gustavo and our other two partners put it together and have gone forward and trying to raise funds to invest in a lot of these interesting startup companies in Latin America. Over to you.
Thank you very much. So let me get started. Some of these points, we're going to touch on several things, but to get it started, give me just 1 second. I need to go back here. All right. Give me just 1 second. I think I went too far here. So one of the things that we are seeing in the region is this great opportunity. As Barry was saying, the shift to knowledge-based economies, and when a key thing for all of this is the fact that these companies, these startups, where 15 years ago they'd take a long time and certainly a lot of investment to get going, it's become a pretty standardized process now. There's infrastructure out there. There's just methodologies as to how to do this that allow these small companies to get going very quickly. And we'll see that example in Chile and a number of other Latin American countries. And another thing that's been helping put this Latin American ecosystem sort of on the right page for us has been this accelerator model that's really widespread. So accelerators, incubators are not just United States kind of thing. I mean, even though they were spawned here many years ago, now there's many countries around the world in emerging markets like Mexico, Colombia, or Chile that are using this model, and really requiring a little bit of an investment, not so much. But the main thing about these accelerators is the mentorship, the mentoring, and the administrative support. That's really the key behind the success. It's not enough to just be an angel investor and put money into these companies and take up on a passive role and hope that they are successful. It's really about it's hands-on. It's how are we going to mentor these companies? How are we going to help them administratively so that they really concentrate on what they need to do and hit their milestones? So one of the other things we see in Latin America is that venture capital, as we understand it in the United States, and there's certainly a number of venture capital firms in Latin America, however, they're a little smaller than the typical ones in the States. They have been a lot more reliant on accelerators. They're certainly depending on many of these accelerators to get some of their deals done, funded. And so that relationship has been strengthened over the years. And we also see that there are many more companies now getting funded and finding traction. So it's not just about an idea that somebody put together and they're trying to figure out what they're going to do with it. Some of these companies are actually having revenues, they're having traction, they're gaining popularity in countries that we'll discuss. So our focus is pretty much Spanish-speaking Latin America. So to make that distinction, that this is not a Brazilian play. This is really the Spanish-speaking Americas, which is a very large region, stretches from Mexico all the way down to the tip of Argentina and Chile. And we're looking at a market of about 300 million people. So it's a substantial market. It's a growing market. Has a common language, common culture, and the challenges are very similar, at least from the governmental standpoint and from the entrepreneurial standpoint. But we have seen very seriously that the region is incubating over 400 companies a year. So these are formal, incubators that are having these companies and creating opportunities for these companies. Now, just to give you some quick stats, the World Bank states that Latin America is leading the global mobile growth. Latin America online users were up 16% in 2011. That's much faster than other regions, and that 16% figure has been continuous since 2011. And then the IMF is saying to us that growth has been very robust in Chile, Colombia, Mexico, and Peru. I would say Peru being the fastest growing country in Latin America for the last 6-7 years, followed by Colombia, Chile, and then Mexico. Recently, Mexico's growth has not been as stellar, but it will be based on the new legislation in various areas, including, of course, energy and telecommunications. Let me move on to where we see this opportunity. So, Startup Chile. Chile is a country that we believe is sort of the beachhead. It's sort of the initial stage of startup growth in Latin America. It has a very stable economy. It's been the most stable economy in Latin America in the last 40, 45 years. It is providing a number of, a lot of dollars to companies that the government of Chile some years ago decided that Santiago, the capital, and the country as a whole, was going to be the center for entrepreneurs in Latin America. And they've basically done that. They started a program, Startup Chile, 5-6 years ago, with a few companies then, and they were providing $40,000 to about 300 firms a year. Initially, of course, there were many, many fewer companies than that, but now we're looking at a country, a government that, through one of their programs, which is Startup Chile, is providing this kind of money to the companies. We've also seen that there are a few very active accelerators in that country, NXTP Labs being one of them, Wyra, another one, 500 Startups, another one. So they're all kind of, they started concentrating in Chile. They've moved on since to other countries, so they're all over. But we also see very active VCs, venture capitalists, such as Catholic Ventures, Alpha Ventures, Aris, and then what Derek was talking about a few minutes ago, this matching, this leverage that we have, that for every dollar we raise in a place like Chile, the government, if you're using government programs, that government can give you another $2. Mexico and Colombia have started this more recently, but the whole region is moving in that direction, where governments are realizing that the knowledge economy is going to help them create jobs, put them on the map, and have better economies at the end of the day. So here's the big opportunity we see. So initially, as happens in the United States, companies get started with family and friend money. Then they've got, in some cases, they go to accelerators and incubators, and they're there for a bit, maybe 6 months, maybe 3 months, maybe a year at most. And then, of course, they may receive institutional money, such as happens in Chile through Startup Chile. The issue is that once those resources are used up, and it could be up all the way up to $100,000, $120,000 in a place like Chile, these companies have nowhere to go. So they use these funds, they develop to a certain extent, and then it dries up. The well dries up. Venture capitalists are not getting involved in the $100,000 to, say, $400,000, $500,000 level. It's just not cost effective for a venture capital firm to get involved at that stage. So they're starting out at the close to the $1 million level, or certainly above 500,000. And so some of these companies that have done phenomenally, that have very talented entrepreneurs and teams, fold. At the end of the day, they just simply don't have the resources to continue. And there's in this valley of death that you see in the graph, that's where you see that our opportunity lies, and that's where we want to be. Now, let's talk a little bit about our model and where we come in. As I said, we're trying to bridge that funding gap, and we're looking at companies with strong traction. We want to create a sustainable deal flow. One of the things that we've seen is that there are companies out there that do well, but few and far between. The objective that we have is, let's create a funnel where we have these companies consistently coming through it, through incubators, accelerators, of course, and then getting funded through us, and then continuing on in an M&A situation or an IPO. But that sustainable deal flow is key. It's critical. We also want to make sure that there's more investable opportunities at less risky stages. So we're not talking just about, oh, here's a company that has an idea, or here are some talented entrepreneurs who have an idea. It's a lot more than that. It's companies that actually have traction, they're actually producing things or services. And at the end of the day, the perspective for real positive change in Latin America is there if, of course, we continue with this process and make sure it's implanted in the right way in these countries, not just Chile. We're talking about, as I said, Spanish-speaking Latin America. So now you see, I think, a better picture of where we are in this process. So initially, you see on the left-hand side of the presentation, the accelerators and incubators in Chile, and Mexico, Colombia, and Argentina, that basically that $100,000 threshold, that's where they end as far as the resources is concerned. Then you've got in the middle of that, the middle column, you see venture capital angel funds. Yes, there's a few of those, but they're few and far between that actually investing there. And that's where we are. This is where Origo Ventures appears, and this is exactly what we need to do. So we take on those companies that are coming out of the incubators and accelerators, and then we mentor them. We really take them on hand, and then hopefully deliver them to either more venture capital money, angel funds, or in an ideal situation, bring them to the United States for additional mentoring and exits. Now, what do we want to do with some of these companies? Of course, our model is about investing in companies that need traction, okay, that already have traction but need more of it, let's put it this way. So that's a very important part to this. It's not an idea. It's something that is working, that has traction, and maybe it has traction in their particular country. Maybe it's a Chilean play for now, but that play can become a Colombia, a Peruvian, or a Mexican play. Greater growth, certainly a Latin American platform in that Spanish-speaking market. And our initial investments go between $50,000 and $150,000. The idea is to dominate the local market and take it from there to other platforms in other countries. We will do follow-on investments up to $400,000. Again, as I said, the regional expansion is very important. It puts these companies on the map. If there are U.S. companies concerned that are interested in Latin America, well, this is a very interesting play for them to be presented with a company that not only started in a Latin American country, but has expanded, has roots in other countries in Latin America. So it's a much bigger play and a much more attractive play, certainly, for a U.S. VC or a U.S. company. Now, we will invest up to $1 million for that regional domination that we want to establish for these companies. And I think the idea of the mentor founders is very, very important. It's really the key to these things. It's, as I said before, it's not just about putting money into these things. It's about helping them grow in a very healthy way, mentoring them, and I'll talk a little bit about that, how that works. That step process we have to mentor companies in just a second. And in some cases, of course, we will reskin these companies so that we can take them to Silicon Valley or New York City or Austin or Boston in the United States and exit them there. Could be Europe, it could be Canada, it could be other locations, but we believe that most of these will, the ones that have very good growth, stellar growth, will be able to exit in the United States. Our target is, of course, exits of between $25 and $75 million. Now, remember, these companies start off with $50, $100, $150,000 investments from our side, and they are supposed to reach certain milestones, and that's where we come in and how the mentorship program comes in. Now, industries we're serving, software infrastructure, games has been very popular in Latin America. Mobile, the use of mobile technology in Latin America is very, very pervasive. Consumer internet, business to business, some energy, some biotech, more so the analytical part of biotech. And in the hardware space, we're talking about medical devices and consumer hardware. Now, we're not concentrating in a particular area or industry. We have limited deal flow. We want to create more deal flow, so we're very opportunistic about our investments. Now, what you see here is the whole idea is to minimize friction, right? So if you look on the left-hand side of your screen there, we are looking at companies coming out of accelerators, incubators, Startup Chile, we're selecting the best companies. We're trying to make sure that they continue toward the regional expansion. Of course, we realize that not all of these companies are going to be successful, and we'll talk about the success rate that we expect from our investments in a sec. But the idea is that these companies have a regional expansion, gain additional traction, and then either exit in their particular area, country, or they actually have additional funding and are exited in the United States. Now, very important pieces of this, very important, I guess, ingredients of a successful exit, two things: partner firms, and you'll see there Mexico and Colombia. In other words, who are those companies, those funds that are going to help some of these companies that we're already starting investing in, let's say in Chile? How are we going to get those companies adapted to a Colombia or a Mexico? Well, we certainly are thinking about partnering with firms that will help these companies adapt to these markets from a cultural standpoint, from a financial standpoint, just an accounting, legal perspective. And then there's the part about mentorship. Mentorship is key, as I said before, to the success, whether it's design or it's a legal aspect or strategy or engineering or marketing or IP. These are key to success, and I'll just get into very quickly into the 5 levels of mentoring support that we have talked about. On the left-hand side of the screen, you'll see EIRs, which is nothing more than entrepreneurs in residence. These are people that are on the ground in places like Chile, entrepreneurs that we as managing partners know, who will have weekly discussions, monitoring for the needs and areas to support for a lot of these startups. So you have to have somebody on the ground talking to these companies all the time. And there are plenty of entrepreneurs out there who are willing to give up their time to do this. It's actually voluntary for the most part. Then you've got ourselves. As managing partners, we're 4 managing partners. Our commitment is a bi-weekly to monthly interaction with the companies we're supporting, and then monitoring the milestones, assigning resources, investments, recommendations basically as to what to do to these companies. And that's kind of our role in this process. There's another one that is operational mentoring. So these are people who are going to be having the weekly interaction with these companies, but we'll be doing a lot of hands-on things like courses or just individual consulting, technical assistance, legal assistance. So again, people on the ground who know business in those locations. And then there's strategic mentoring. There are people who have joined us as advisors, who are like our model, who say, I'm interested in helping these companies succeed from a strategic perspective. So that just depends on what each company needs at the time, but certainly the strategy side of it is extremely important. And then the last piece is the associated partner fund. So this is what I was talking about a few minutes ago, where if a startup company, in, let's say in Chile, wants to move into Mexico or Peru or Colombia, we have to assist them. And the best way to do that is to establish a coordination with partnering with funds in those countries for all the legal, the accounting, the business support that they will need. Let me move on now to as far as what we do and how we do it. Well, certainly we need to take a look at the best opportunities out there. And the fact is that our managing partners are involved in both the accelerator and the incubator selection. And from there, it's setting the milestones for these companies. That's really a key part of it. So we are familiar with the kinds of companies that are coming out of these accelerators, much before they come out. So we've been advisors or mentors to many of these companies. And then I think being entrepreneur-friendly is extremely important because what an entrepreneur wants is quick decisions, really efficient due diligence, very clear term sheets, and certainly reliable funding. So those are the things that we bring to the table. And the mentoring, as I said, the mentoring is the key part to this. As what happens here in the United States with, say, Y Combinator out of the Silicon Valley, the mentoring part of it is the critical aspect to the survival of these venture capitalist groups. That is, and the acceleration incubators, that is a key part to their success. And the partnership with firms in the United States to land and reskin these companies, well, in some cases, that's certainly needed, and we are fully aware of it and have relationships established with Silicon Valley companies as well as others in New York and in Miami. So very quickly about exit. Of course, we want to have direct exits wherever possible. Series level investment where necessary. Again, where necessary, that's the key thing. I mean, if we can lead a company from, its first funding, say $100,000, and maybe we go up to $1 million and we're able to exit that company, so much the better. As I said before, $25 to $75 million exits are targeted. The exits are where most appropriate. It can be in Mexico. It could be. There's some very large, very well-known companies in Mexico, say in the telecommunications space, that do purchase these companies. So that's always an option. But the other option is mostly in the United States or Europe or Asia. Now, very quickly, as far as the expected returns, I think the ones that potential investors should be focusing on are the 5-year investor ROIs and the 7-year investor ROIs. You can see, and I think we're being fairly conservative in our returns. We're looking at a 5-year investor ROI of 45% and a 7-year investor ROI of 72%. Now, the assumptions are important here because 2/3 of our Chilean fund is actually a Corfo loan. Corfo is the development arm of the economy ministry in Chile. Okay, that's all it is. It's a development arm of it. And what happens there is that investors will see a $3 return, say, on a $1 investment because of the leverage that I was talking about. In other words, for every dollar that we raise from investors, there's another $2 coming from a loan from the Chilean government. Now, these loans are repaid as a principal plus a maximum of 4.25% interest. And we're essentially looking at investing in 40 different startup companies. We are assuming, and this is very well established in the venture capital community, we're assuming that there's going to be a total loss for a number of companies, in this case half of these companies. But we're also assuming that another 20 of these companies are going to have fairly good exits, some phenomenal exits, and that's where the money lies. That's where the profits and the returns are going to lie. And these 5 to 9 to over 10 times exit multiples for these companies. And this last slide really talks to you about the investment itself. So the fund name is the Oracle Latin America Fund 1. The fund term is 10 years. Our term is 3 years. So we will be investing in these 40 companies within the next 3 years. So it's not that we've decided exactly all of the 40 companies now. It's going to be perhaps, as far as the disbursement is concerned, during a 3-year period, okay, to reach that 40 company level. And the investment hold is really going to be from 3 to 7 years. We're estimating more on the side of the 5, 6, 7 years. The fund size is $10 million. Now, you'll see there that we want to raise $4 million in private funding. That means that $3 million of this money is actually going to be raised for the Chilean opportunity. And because we're going to raise $3 million, half of it in Chile and half of it in the United States, as you see, the $3 million will be matched by another $6 million from the Chilean government. And then there's an additional $1 million that we want to raise to invest in countries such as Mexico and Colombia directly. That's how we come up with that $10 million you see on the screen. And the investment size, the contributions we're looking for from limited partners is between $100,000 and $500,000. As I said before, the number of investments between 30 and 40. I was saying 40 as a maximum. And we charge management fees of 2.5%, which is standard. And then the carry is 20%, which is also standard. I think I will stop here for questions, Brian. I don't know if we may have some questions. We may have some comments. Be happy to take them. I think as far as the team and the advisors, and Derek introduced himself, I did him as well. We have two other partners, one of whom is actually in Chile. He has had tremendous legal experience and raising funds for a number of startup companies in the area, and has worked with very well-known IP law firms in Chile. So we can go into that, but I think that, the main idea was for us to go through our model, why we're doing this, why this makes sense, and why this could make sense for potential investors.
Right. Well, it was very informative for me here. I don't see any questions right now from our attendees, but if somebody does have any questions, you have your contact information, Gustavo, so people can contact you.
Yes. So let me see. We have, I want to make sure that, so you see on this screen here, this is our address in La Jolla. Our phone number is 858, as you see it on the bottom of the screen there, 736-9225. We are obviously a U.S. company. It's a U.S. fund. But we can certainly talk more detail as to investments and any questions that people have. Our website is www.origoventures.com. Myself, and I know that doesn't show up on the screen here, but it's G de la Fuente. That's G as in good, D as in Daniel, E Eric, L Larry, A Apple, F Frank, U, E Eric, N Nancy, T Tom, E Eric, at origoventures.com. That's Origo with O-R-I-G-O, ventures.com. And Derek Footer's email is D as in Daniel. Footer is F as in Frank, O-O-T as in Thomas, E-R at origoventures.com.
Well, thank you very much. Very informative. For those of you that might have jumped in a little bit late, we are recording this. I will have a recording of the presentation today if anybody wants that, and I'll be more than happy to share it with everybody. I want to thank everybody for taking the time out of their day to come and listen to our webinar. And I want to thank Derek, you, and Gustavo personally for all the information.
Thank you, Brian.
Thank you very much.
All right, guys, we'll talk soon and hope to do it again.
Thank you.
Bye.
Bye-bye. Great.